Welcome to a weekly look at gold fundamentals with David Jensen. I'm your host, Jay Taylor, and I'm really pleased to have David with me again. Welcome, David.
Good afternoon, Jay.
Yeah, you and I talk a lot of times about the propaganda that we're subjected to constantly from the mainstream press. One of the big players in the media, Reuters. You're talking about Reuters, and they have quite an interesting history in terms of playing a propaganda role in the UK. Would you care to go ahead and talk about that a bit?
Yeah, I'd be happy to. I was interested in pursuing Reuters a little bit because I found it interesting that the LBMA, the London Bullion Market Association, after questioning of the actual fixing of gold and silver there, and accusations of collusion and fraudulent trading, had chosen Thomson Reuters now, not just the old Reuters company, but it's been acquired by Thomson Group. It's called Thomson Reuters, and I had chosen them to help administer the daily silver fix. And silver has a history as the daily monetary metal for trade between people. So it's really not even gold so much, but the direct threat to the fiat currency system in terms of daily transactions, because the value is considerably less than gold, and it can be used for day-to-day. And it was noted that it has been historically the primary monetary metal for day-to-day transactions. So I started reading a little bit about Reuters, and I've been pursuing a few books on them. And I'm reading a book right now called The Power of News, The History of Reuters by Donald Reed. And, I found it interesting in this book. It delineates, in this book and a couple of others, delineates how Reuters had acted as an arm of the UK government in issuing war propaganda in World War I and World War II, and also following further on in the timeline of last century that in the 80s and 90s they'd been receiving secret subsidies from the UK government to pursue non-economic interests. But the fact that they were not disclosing this publicly, and they were fronting a lot of the money through the BBC, it's concerning to me, because you have an accusation of fraudulent and collusive activity on the LBMA, and then the UK government, or the LBMA, pardon me, responds by using a company which has historically acted for the UK government, and also most recently there's numerous, and people can look this up on the web themselves, and I'll post some show notes, links in the show notes, but basically that there's numerous accusations of Reuters apparently providing fraudulent reporting from Syria and Iraq and Lebanon and other places. And it's really quite amazing to me that there's questions about something as important as the precious metals markets, and this is the solution.
Yeah, the solution is to keep people in the dark, as I like to say, down on the mushroom farm.
Well, yeah, but it's just on its face. You'd think that it would be a little bit more. I can say a little bit more sublime than what we've got here. It's just kind of like, are you guys kidding? This is your solution as a company, and the examples of fraudulent reporting from the Middle East over the last decade and a half are legion, and so it's really quite something. And it's I just want to pursue this a little bit further, and we'll continue to read up and follow them in terms of what's going on, but. Let's just say their pedigree is not the best, and it's certainly not who you'd bring in, I would think, who you would bring in to clean up a situation where there's questions raised about propriety.
Yeah, if you're really serious about having a fair and open market and a truthful market, I guess you would try to find somebody who is clean, so to speak, and but maybe if you're not trying to do that, you would have somebody that you can depend on that's been good to you, that's been serving your purpose in the past, I suppose.
Yeah, and they could also start with doing things like posting open interests, daily trading volume, explaining the amount of leverage that's in the market, explaining exactly how much metal is backing these contracts. I mean, that's where you'd want to start.
Sure.
I would think, if you were really sincere about cleaning up the system.
Any sense that they're doing that?
Not that I've seen.
No, I wouldn't. Yeah. Well, the problem is, of course, we're not seeing what's going on in these markets because, well, for whatever reasons, whatever the motives are.
Yeah.
So it is causing a lot of distortions in the market, and you're making a note that, in fact, there is further evidence of gold market problems. There's major market participants that are leaving the market, that are leaving their participation in the metals markets. Talk a little bit about that, if you would.
Well, the precious metals markets trading overall is an opaque market, and we're really stuck with trying to create a mosaic, and it's just piece by piece we put it up, and not every piece doesn't always fit, but we try to put up as many of the pieces as we can and try to discern what is going on. And certainly it's of interest to me that the number of large market participants who have been leaving the precious metals, the physical precious metals space. This past week now we have this company Gunvor, which is I think it's the 5th biggest commodity trader in the world, leaving the physical gold trade business because they say they are unable to source what is quote unquote well documented gold, gold for which they can tell where it has come from and what its provenance is. And we also have Johnson and Matthey this last week after 160 years. I mean, that's one of the the real stalwart names in the precious metals space. We have Johnson and Matthey leaving the precious metals refining business after, as I said, 160 years. And then also in the last few weeks now, we have Deutsche Bank announcing that they're leaving the physical metals trading space.
Why in the world would these people that have been involved forever?
Yeah,
Gunnar not as long as Johnson Matthey and Deutsche Bank, of course, but why would they be leaving, David? Why do you think they're leaving all of a sudden?
There's always a variety of reasons why different companies do different things, and we'll have to see if this pattern keeps up. But certainly looking at the LBMA and what has gone on in that physical space, and as we talked about last week, Jay, in the whole discussion about rehypothecation and creating multiple claims through lending of repeated lending of the same asset, and also the unallocated metal instruments which are being traded in London, is that you ultimately have then assets which are being traded and being sold which have potentially multiple claims on them. So if you have an asset, a gold bar, and it's really owed to half a dozen or a dozen or more, up to 100 times is the estimated leverage in London. But if you have these multiple claims on assets, and then you are participating in the chain of custody and the disposition of these assets, there is the potential there for the parties that are involved in these fraudulent transferences of being implicated. And that is something that has occurred to me, is that this may be why we're starting to see some of these big names get out of this business, just as it looks like what is going on with Russia and China, having announced last summer that they're no longer going to accumulate U.S. dollar assets, and it appears they're going around the world buying real assets, including some large announced purchases by Russia of gold. The Chinese are a little bit more circumspect, and we're expecting a big purchase from them. But certainly we would think that this system will come undone in London. And I would think that as it is coming undone, that nobody wants to be left holding the bag, as it were, or directly implicated when the public's attention is finally drawn to it. So we'll have to see where it goes. But it was just very it's curious to me to see these three big names, and they're not insubstantial names, leaving the business in such rapid succession.
Well, David, but what you're talking about here would be criminal. The notion of pledging an asset multiple times, making each person believe that they were the sole owner of that asset, or that they had sole claim on it. And but we know from experience in recent years here, the last few years, that crimes don't go punished. And essentially, somebody says, "Oh yeah, we did some things we shouldn't have done." They pay a big fine and they go away. Isn't that? But maybe the laws of nature won't allow that to happen. Maybe it becomes so blatant and so obvious, and people become so angry that they won't put up with that. And so, the handwriting might be on the wall for some of these big institutions, realizing that they're going to be up the creek without a paddle.
Yeah. Well, I would a couple of responses is first of all that precious metals manipulation, I believe, is at the center of interest rate manipulation.
Sure.
And when you manipulate the gold price and the silver price, you really manipulate the global price of it, and as a consequence, you impact global interest rates. And we are at the end now of a massive multi-decade debt bubble, which appears to be caving in on itself. Secondly, there's also there may not be criminal prosecution, but certainly shareholders of these companies and also people who have been wronged in the precious metals markets. You may have some class action suits where they come after anybody and everybody who is involved in this rigged market and the destabilization of these markets.
Mm-hmm.
So that may be what is going on here. But the big picture here is that it seems to be coming undone. The UK government, to me, showed their hand fairly clearly in the late 1990s in selling 400 tons, of the British people's gold to solve a market crisis, quote unquote, and to sell the British people's gold at $256 an ounce. When there's 170,000 tons of gold available above ground, I mean, it's pretty clear advertising that the UK government works for the City of London and the banks or the institutions that are there, and not for the British people. And now we see this perhaps an accelerating exodus from the gold and silver space, as would be expected if the whole rig is going to come undone now with the removal of physical gold from the market and really the termination of the ability to create metal from nothing and trade virtual metal and set the price. So.
Yeah, that's very interesting. And you mentioned the City of London. Again, I think that most people probably assume, as I have for many years, that the City of London is just really a part of the UK. It's part of Britain. But in fact, it's my understanding that the City of London is a government in and of itself, right?
Yeah, it's the square mile. It has its own Lord Mayor, and even the Queen, when she's in the presence of the Lord Mayor, is supposed to walk behind the Lord Mayor. So symbology is a lot. It means a lot in the royal circles, and who knows what that means? But it's of interest, anyways. That perhaps the order of things that we see is not the order, as it were.
As it appears to be. The order that appears to be, that Reuters would have us believe exists, perhaps. It's somewhat different. Perhaps the power is behind the throne. I mean, it's symbolic. Why would the Queen, the Queen or the King is supposed to be at the top of the pyramid, right? Why would the Lord Mayor of the City of London be marching ahead of them?
We don't know, but what we can see is that the interests of these metals traders in that area are being put ahead of the British people. And certainly, if you want to distill it down just to factual matters, is that it appears that there is a serious problem with the LBMA, and that it appears that people are exiting that market in quite quick succession, and that the ultimate solution is a new trading platform for gold, silver, and platinum group metals in an open and honest forum, which gives true value and fair weights and measures.
Mm-hmm. That's what we want. Of course, that's what we, the people, want. But, of course, those people that have control, as long as they can keep us in the dark, they can continue perpetuating the fraud that's going on. And, that's certainly, it's just so important. It's not about gold. It's not about making money in gold. That's not what I know you and I are about. It's the bigger picture. And as you've pointed out in our discussions before, Larry Summers and other people that have been near the seat of or in the seat of power understand very well that the only way they can continue to artificially suppress the interest rates is if the gold price is contained. So, it's just a really, really important issue that, of course, 99.99% of the population has no clue about, I'm afraid. But one thing I'd like to...
Sorry,
go ahead. Yeah.
Just a comment here. Is that, the repression, what is called financial repression, what we're seeing here is an effort to keep the bond market in place and to keep the bond market functioning without clearing the bad debt and without a debt write-down, so that you keep the debt instruments in place. So, the repression that is going on and the suppression, really, of people globally is being done by containment of interest rates. And what we need is higher interest rates, both because of the Austrian school concept of time preference, where you need higher interest rates to act in a disciplinary fashion to bring highly productive projects to market, and only the highly productive ones. And we also need an orderly write-down of debt, which would mean it would basically blow up the too big to fail banks because of the leverage that they hold in their balance sheets, which is of the order of about 15-1, I believe, in the States. So but ultimately the markets are going to do what the markets are going to do. You can do things for a period of time. You can engage in currency manipulation. You can do all kinds of things in the short term, but they don't deal with the fundamentals. And I think the central bankers well understand that.
David, one of the things that you and I have been talking about in our discussions over the last few weeks is the GoFo rate. And you made a point that the GoFo rate, I think the last time we talked, in fact, it had gone negative, and then it was followed by a pretty big run-up in the paper markets. Yeah. But would like you to address a point that I mentioned last week when I did this little discussion alone, and that is that James Turk was questioning really the meaningfulness of even looking at the GoFo rate, because he says that the banks that are making that market are essentially free to put any number they want on the interest rate for leasing gold.
But yeah, James's comment, I believe, was that the central banks play almost exclusively in that space. Pardon me. I mean, the whole issue there of the gold lease rate spiking and positive, and the GoFo rate spiking negative, where the GoFo or the gold forward rate is equal to LIBOR minus the gold lease rate, and also gold price backwardation, where your spot price surges ahead of your near futures or forward contract. All of those things are really indicators of the same thing. But James's comment, which is a shortage of metal, pardon me, and the comment you and I had, Jay, or the discussion we had, was really that the fact that the price was unable to respond despite the indications of physical shortage in the market, and how that indicated a bifurcation really of the paper trading market in London, and then the global physical demand for gold, which is running at really a torrid and unprecedented pace. But James's comment back to that again is that the fact that this is the domain of central banks, because they basically lend in 1 ton blocks, and no one else wants to enter that space. But when you have 5 billion ounces of gold above ground, and the fact that the true market participants have exited that market, leaving only the central banks to set the lease rate, really is an indicator of market failure. One more indication of market failure. And the comment has been made in the past that the markets really failed in 2008, 2009, and they've never really recovered. And certainly that would be one more indicator that we've got artificial gold markets and artificial suppression and cobbling together of the financial system.
Mm-hmm. Well, certainly, most people have the notion that the gold market is very small, that there's not that much dollar value traded in gold every day. I know some of my colleagues on the speaking circuit at the Cambridge House shows, mostly the Keynesian folks are of that opinion. They believe that that what are you getting concerned about the gold, Taylor? It's nothing compared to the treasury markets, compared to all the paper markets, and I guess the amount of gold that trades every day, that might be the actual physical gold that actually trades every day. But could you put this in perspective for us, David? Give us some sense of how much. Maybe look at oil in terms of gold. How do the two stack up in terms of the amount of dollar volume that's traded on a given day? Sure,
Jay. We talked the last time about comparing gold versus the New York Stock Exchange, the volume traded in London, which is about 85% of the global gold trade market, versus just as a benchmark of the New York Stock Exchange, and in round numbers, there's about 4 times more gold traded daily than this turnover volume in New York on the NYSE. And I've just dug up some numbers here, some round numbers scaled just as approximations. But what we see here is that on a daily basis, with global oil production and pricing oil at about $60 a barrel, and gold at 1,200, we got about 15 times as much oil produced daily as gold produced daily globally from mining.
Mm-hmm.
So there's a 15-to-1 ratio in terms of size. But what is interesting is if we look at the NYMEX, which is the preeminent oil trading platform, they trade about 1.2 billion with a B barrels per day on that platform. And using a $60 a barrel oil number as a round number, they're trading about $72 billion a day of oil futures on the NYMEX. And the most recent numbers, they've got the October 2014 numbers out now on the LBMA. They're trading about 174 million ounces of gold a day. And using $1,200 gold, that's about 209 or $210 billion of gold that trades every day.
Mm.
So here we have the gold volume, and that's using the 10-to-1 ratio that the LBMA posts in terms of their gross daily turnover versus their net end-of-day settled turnover.
Mm-hmm.
So we have about 3 times as much gold traded daily as oil is traded daily. So there, again, is one more indicator of the size of the gold market in terms of daily volume and how fast they're actually spinning this machine in London by trading these virtual gold instruments, helping to contain the price of gold.
I'd be interested in knowing what sort of percentage of the oil actually gets settled then, and how much of it is just paper oil that's trading. Do you have any sense of that?
I don't.
Okay, well maybe that's
just daily turnover numbers, just as rough for the purpose of rough comparison.
right. Well, that is really something, because when you look at the fact that there's so much more oil produced every day than gold produced every day, and yet so much more gold traded in notional value, at least, as opposed to oil. That is really very remarkable. And so you have all these people that think they're actually trading gold.
Yep.
They have virtual gold. In their minds, they are protecting themselves by having this negatively correlated asset in their portfolios. In paper, they think they really own it, but they don't. And so all manner, as we've discussed constantly in our discussions, they play games with the paper gold. One other issue I'd like to ask you about this week, and that has to do with an article that was written by Steve Seville, who is a frequent blogger writes a lot of things on the topic of gold and silver, etc. And he's basically suggesting that there is no manipulation of the markets. I think you might have read a recent article that he wrote. What are your thoughts on that?
Yeah, I did read through it, and it's an unfortunate article because it's really conventional thought as opposed to digging behind the numbers a little bit and understanding the true nature of the market. But he blunders through a whole series of points regarding the gold market. But he's saying that there's so much gold above ground that people that look at mine supply are showing that they don't understand what they're talking about. But the concept of gold here is that annually, there are 170,000 tons above ground. That is very true, but very little of it is available to market. It's tightly held, and so you need a little bit of time to settle things out with the gold market because of this tightness in the market. But if you look at round numbers, using the GFMS numbers, that they look at about 2,900 tons a year annual mine supply, and about 4,500 tons a year of total physical gold movement. Now, in reality, these are estimates, and nobody truly knows the size of the market. So we're stuck with these estimates, and certainly there's been a lot of question in terms of the World Gold Council and some of what I think is really disinformative material that they put out. Especially regarding the size of the Chinese market. But we look at things like the mine supply and the Chinese market, because the world's gold market doesn't consist of 170,000 tons a year that gets turned over. People have these things in artifacts, and there's large amounts of gold that are tightly held by private interests, and it just does not enter the market. So that's the first point there, is that we're looking at the annual mine supply because that is a metal that's going to hit the market, and it's going to hit the market in size of roughly about 60% of the total annual estimated physical gold market transactions or movement of metal. So that's why we look at the mine supply. The second thing he was saying was, well, if the demand for physical rises, the price will surely rise. And what he's confusing there, and really he's conflating the nature of the LBMA quote unquote physical market with something like the Shanghai Gold Exchange physical market. And there's an enormous difference between these markets. In that, in Shanghai, you have to deposit a kilo to sell or to trade a 1 kilo contract. You don't do that in London. They say the majority of the trading is unallocated gold, and we know of the rehypothecation and leveraging of the contracts there. So what they're really doing in London, in the notionally physical market, is they're creating physical metal positions, which very large institutions sit in, thinking that they're actually sitting and holding gold. Mm-hmm. And really what they're holding is fractional reserve gold, which has really mind-boggling leverage in it, where there is apparently about 1% of the gold that's really back in. Keeping in mind with these types of daily turnover numbers that we're seeing, that we're looking at anywhere from, let's say, 300 to 500 million ounces of open interest in London. We don't know exactly what the size is, but this is a repository that can be expanded at will using leverage in London. And so the key here is that the demand for physical gold only matters if it results in the withdrawal of physical gold from the market out of the LBMA. Mm-hmm. And the vast majority of trading happens on the LBMA, and the gold sits, or the notional gold sits in the system. And so with this unallocated artificial supply of metal, they are able to notionally create quote-unquote physical metal to meet physical demand, but it truly isn't. And as with all Ponzi schemes, Jay, they only last as long as the investors are kept sanguine and unaware of the fact that they're just building up an enormous pyramid scheme. And the whole thing comes down when the fraction of assets is withdrawn from the system, bringing down the whole pyramid scheme itself. And I think that is what is happening right now with the announcement last summer of Russia and China, and the announcements of the purchasing of large amounts of physical gold, and the spiking lease rates in London, which we're now today, by the way, it's the 17th of December. We're seeing the lease rate came down sharply, and now it's heading right back up again. So we'll see where that goes. But it certainly appears to me that there is a gold Ponzi scheme which has been run, and this physical gold, notionally physical gold, has been created at will, much as currency is created by the banking system, and that this is what is coming unwound now. And I really suggest to Mr. Seville that he read about leverage and understand how these physical markets work and how they can create physical supply to really satiate physical demand, so long as that demand sits in the London market and it isn't withdrawn from the market.
Mm-hmm. Well, I think that Mr. Seville is not doing anyone a service other than those perhaps who are perpetuating this fib, this lie, essentially. I mean, maybe I don't know Mr. Seville personally, so I don't know what his motives are. He probably really believes what he's saying. But I think that in order to change things, to get things back on where they need to be, we need to know the truth. And as you pointed out, Reuters and other propagandist, and I honestly believe that most of the people that are reporting the news are clueless. I don't think that they're really doing it intentionally, but
no. They're just compartmentalized and clueless, and they're not asking the next question. And Seville appears to come from the place that I once populated, which is that you just take things at face value, and you don't ask the next question. It's like, okay, well, there's physical gold, that's a physical market, there's physical demand, the price has to rise. And what he's not doing is pursuing the concept of leverage and unallocated positions in very, very large institutions holding positions in the LBMA and being satiated in their demand by the creation of this virtual metal. And that really is the key to what's going on, Jay.
Yeah, I believe that's absolutely right. Of course, it's not always comfortable to ask that next question that you're talking about, because when you ask that next question, sometimes you're knocking on the door of the people that don't want you to know what's going on. I want to thank you, David, again for your work and your for honing in on this stuff for us, because I think it's going that step further in understanding what's going on that is most valuable. And the reason that I want to spend the time with you each week to try to pursue what is actually happening in the gold and silver markets, as you point out, silver being very, very important and more as a retail and everyday metal. Certainly, if you want to have some junk silver around or some low silver coins, I think you want to have something like that around so that you can go down to the corner store and buy some milk if the currency is no longer, or bread or whatever else sort of daily consumption items that you need. So that makes a lot of sense. But thanks again, David, for being with us again, and look forward to doing it next week.
Thanks, Jay. Just one closing comment here.
Sure.
That, we'll just keep putting together the pieces of the mosaic. Not everything is relevant and not everything is meaningful, but I think we can put together the big picture. And certainly as time, I've been in this space now for more than 10 years, and the discussion of currency crisis was really anathema to thinking people and rational people. And we can see now how, we've got the Russian ruble now in crisis. The reasons for that is a whole separate issue. But, the people's minds are being opened up, and they're asking the question, and they're observing. And I think that's just what we have to do, is keep open minds, observe things, ask questions, be rational about things, and just put the pieces up and see if they fit. And I think, we'll be successful in putting together the big story here, I think, in which is going to be, I think, one of the most tremendous markets, perhaps, of the last several centuries, as the understanding of the populace is drawn back to sound money, which is gold and silver.
Absolutely. We can hope it works out that way, because if we don't go back to a sound monetary system, we're going to continue, I think, sort of spiraling down into what Robert Prechter calls the new dark age. And anybody of sane mind does not want to see that happen. Thanks again, David, for being with me.
Thank you, Jay.